Students continue to call me with problems about 3.04. It's a difficult assignment, but one that you'll have to master if you're going to do well on the AP exam. The first part of the assignment asks you to fill in two tables. The first table has disposable income and consumer spending given to you, and you need to calculate savings, MPC, and MPS. Well, savings is easy because you simply subtract consumer spending from disposable income. So in the first line, we would see 3,000 minus 2,000 is 1,000. In the second line, 5,000 minus 3,000 is 2,000. MPC is a little bit difficult. You're looking at the change in consumer spending divided by the change in disposable income. So the change in consumer spending in year one, well, we don't know because there is no year zero. The change in consumer spending from year 1 to 2 is $1,000. $1,000 divided by the change in disposable income, which is $2,000, is 0.5. And that would be your MPC. For the change in MPS works the same way, only we're looking at the change in savings. In this case, also $1,000 divided by $2,000, and it's 0.5. We can check to see if we have the right answer because MPC plus MPS always equals 1. The second table asks you to calculate the spending multiplier and the tax multiplier. The formulas are given at the top of the table. We'll use, since we're given MPS, 1 over 1 minus MPC. So to do that, 1 over 1 minus 0.9 equals 1 over 0.1 equals 10 for the spending multiplier. And the tax multiplier is minus 0.9 divided by 0.1, which is going to equal minus 9. And you just work every problem that way. Now the third problem is a little bit different. The third problem is a little bit different. You're going to be doing MPC and MPS based on, it's like a word problem. So you'll do it the same way you did the first two columns. In the second question, we better look at that one because it's the one that causes the most trouble. If AD increases by $500 when Congress increases spending by $100, what is the MPC? Well, the first thing you have to do with this question is find out what the multiplier is. In order to find out the multiplier, we're going to divide the $500 that AD increases by the change in consumption, and we see that the multiplier is 5. From there, we can simply plug it in to our spending multiplier formula and solve for MPC. So it's 5 equals 1 over 1 minus MPC. Since you've all had algebra, you should be able to solve that problem and come up with what MPC is. For the final problem, all you have to do that one is simply calculate the tax and the spending multiplier from the data given, multiply the tax multiplier times the change in taxes and the spending multiplier times the change in spending, add those two together, and you'll have the change in GDP. Please call if you have any questions or don't understand this tutorial. Have a great FLVS day.